Thank you for tuning in, and let's begin. Welcome to Blue Ivy Learning's webinar number 9 on the topic of youth financial investment education. Our speaker, Mr. Henry Ying, is president of Long Faith Capital, LLC. He's a registered investment advisor with 20 plus years of experience in the investment industry. MBA from one of the top schools from the University of Chicago. I'm Marina, and I'm a freshman at Johns Creek High School here in Georgia, and my co-host Alina will now share a little bit about herself.
Hello, everyone. My name is Alina. I'm a sophomore at Johns Creek High School, and I'm excited to be here co-hosting with Marina Chen.
And to attest for his high skill level, Henry Ying's investment performance has consistently surpassed the S&P 500 for the last 10 years. Throughout this presentation, if you have any questions, we will have a Q&A session later, and feel free to type it in the Q&A chat. And now to introduce Blue Ivy Learning. The Blue Ivy Learning organization is comprised of 3 sections. Blue Ivy Learning delivers excellent learning services through our result-driven online interactive classes, which include academic, contests, college preparation, financial literacy, and critical personal skill development. Blue Ivy Community Services provides national nonprofit volunteer service that offers opportunities for students who are willing to give back. It also offers help to students who are in need due to compromised school education. And finally, the Blue Ivy Education Forum, which brings you the seminar you're listening to right now, provides free regular education seminars that fosters a community of students pursuing high caliber personal development, including academic capabilities and leadership. And here is a list of our current curriculum. Blue Ivy Learning's current curriculum aims to cultivate students' IQ, EQ, and FQ. And now to Alina with the upcoming curriculum.
So for high schoolers, you may know that the AP exams are coming up very soon in May. Blue Ivy Learning has created these extensive boot camps that will help students prepare extensively for the AP exams. Currently, we are offering 4 different boot camps, which are AP Stat, AP Calc BC, AP Comp Sci A, and AP Chemistry, respectively. Blue Ivy Learning also has created a series of summer enrichment classes for students to continue enhancing their learning over the summer. We will be offering math, reading and science, computer science, leadership development camps, and soft skill development camps.
And now onto our presentation. Let's welcome our guest speaker, Mr. Henry Yin.
Good evening, everyone. Thank you, Alina. Thank you for your introduction. So first, I want to thank for everyone to participate. I hope today you will learn something useful for your life, maybe. So first, why you should listen to me? So you may wonder. So you already got a little bit introduction from Marina about myself. So in the last 10 years, my return rate in the stock market is about 18% per year. So if you guys ask somebody from the financial industry, they know that my record beat 90% of the fund managers on Wall Street or from the financial industry. So that's why I'm not a random guy, I just sell you general knowledge. So what I'm going to tell you today is what I learned from books, from other people, but also from my own experience. So before I talk about what is investment, the most important message I want to tell young people is compounding effect. So in the natural, maybe lesson, I should tell you what is the investment, right? Because we are talking about investment. But I think this message is very important. That's why I put it first, compounding effect. So this will be very useful to you. And even Albert Einstein also agree with me. So what is compounding effect? I think many of you already learned from your school when you do some mathematical formula. If you can grow your base by 10%, so next year you will get 110% of your base. And then another 10% add on. The third year you will get 121% of your base. So if every year you grow your base by 10%, the increase is it's not a linear straight line. The line will go up steeper and steeper. So that's compounding effect. So same thing happens in money. So if you invest some money as your base, as your principal, and if you can keep the return rate consistent every year, then after 5 years, 10 years, 20 years, your money will grow exponentially, not linearly. So that's why I want to let you know, and also why these young people should know this. So compare with older people like me, so or your parents. So young people, you have a great advantage. Your great advantage is you have time. For example, if you start investing in 20 years or age of 20 years or 25 years, or if you start later, you start at 30, still much better than somebody started at 40 at the age of 40. So if you start invest at the age of 25, so by age 50, you already invested for 25 years, right? But you know, most people, they retire at the age of 60 or 65 or 70. So if you have a lot of time, if you have a compounding effect, you will have a huge difference in how much money you will have when you get older later, when you have a family or when you retire. Next slide, please. So this chart, here you have a very kind of simple example. Let's say you invest $1,000 and you can grow the money by 3%, 6%, or 15%. So if your money, if you look at it, the red line, that is in 25 years, your $1,000 will grow to about a little more than $2,000. So you double your money in 25 years with 3% every year. However, if you can grow the money by 15%, the top blue line, then at the end of 25 years, your $1,000 will grow to almost $33,000. So if you look at the interest rate or the return rate, 3% versus 15%, it's only 5 times different, right? You don't even realize how this little difference between 3% and 15% cause a huge difference after 25 years. So after 25 years, one result is $2,000. Another result is $33,000. So 32 is about more than 16 times. So this difference in the beginning in the return rate, as time goes by, will have a difference of 16 times. But for young people, you can not only invest for 25 years, you can invest for 30 years, even 40 years. So that's why you need to know compounding effect. And if you save money, first you need to save money. We will talk more about it later. Second, you should try to, if possible, with reasonable risk. You should try to should think of the different options in your investment. The options with higher return rate, they will cause much, much bigger difference than most people realize. So next slide. By the way, if you guys have any question, please feel free to type in the chat box, and later on we will answer your questions one by one. So now let's come back to see what is investment. So you know investment is important now after the compounding effect. So what is investment? Investment basically is let your money work for you. So most of us, after you graduate from college, or if you talk to your parents, most of us, we make money from our job, right? Either we work for a company, or we own a small company, small business, a restaurant, or a massage or something, or a consulting company, or something. So you work, you use your kind of your skills to get somebody to pay you. So that's one way you earn money. Another way is once you have some money, you can save it. Then you invest the money, you let somebody use the money, then you make money from your money. So you guys should learn this, should keep this in mind. So you can make money in 2 ways. One way is your regular job. Then on the side, you should have your money work for you. Then you have much, much better results than people who only earn income from their regular job. So in investment, typically we have these major categories: stocks, bonds, mutual funds, exchange traded funds, real estate, and some others. I can give you a few examples later on. So first, what is stock? Stock is basically the share of a public company. So the company concept occurred a few hundred years ago. So people organize the society as a smaller unit, like a company. So if we like a company, we like their business, we can buy a share of this company, either maybe 1%, 2%, or sometimes you can even buy 80%, 100% of a company, own a company. So you can buy shares of a private company or a public company. A private company means the companies that their shares are not traded on the national major stock exchange. So for example, if your relative, they own a restaurant and you like the restaurant business, you can buy 10% or 20% of that business. So if the business goes very well, maybe the restaurant will give you a dividend. So every year you earn dividend. And also in the future, you may be able to sell your shares to other people who want to own your shares of the restaurant. So a small restaurant is a private company, private business. So it's not very easy to sell shares of a small business, a private company to other people. It's not very easy to find a buyer. But stocks is relatively easier to find buyers and also traded often. So stocks are shares of companies traded on major stock exchanges. So on the weekdays, except the holidays, during the day, you can trade a stock easily from every minute. So for example, if you buy shares of a company, later on, either you need the money or you have something better to invest, or you think this company has a problem, you change your mind, you can sell the shares easily, sell the stocks easily. So that is stock. So we will talk more later on about stock. Then next we have a bond. So in the stock, you own share of a company. In bond, you don't own a company. Instead, you lend money to a company, and you are not an owner. You are considered as a lender. So, but you should also know bond is different from regular loan. For example, when you want to buy a house, your parents want to buy a house. The bank loan the company to your family, but that's not a bond. The bank doesn't own a bond of you. But if you loan money to a company, there are typically two different ways to lend the money to the company. So one way is you sign some contract. It's not standardized. You negotiate with the company. Say, hey, you need to pay me this much of interest for how long. I want to lend this money to you for 3 years, 5 years, or for 6 months. Then you pay me 3%, whatever. So that is not a bond. That's a private loan or not standardized loan. Bond is more standardized. So the company, when they want to borrow money from you or from the market, so they issue standardized loan, typically in the face value of 1,000. So if you buy one piece of a certificate, you lend $1,000 to company. If you buy two, 2,000. If you buy 10 pieces of a certificate, you lend $10,000 to a company. Then in return, the company pay you interest rate stipulated in the bond. And also at the end, when the bond expires, either in 3 years, 5 years, or 6 months. However, in the beginning, you guys already know when the bond will expire. Then the company will pay back the principal. So on a regular basis, you get your interest from the bond. Then at the end, you get your principal. So another similar kind of feature of the bond with stock is bond is very liquid. So that means if someday you want to use your money, you say, hey, I don't have money to lend to you anymore. I want to get my money back. If you own a bond, you can sell the bond on the market easily. Depends on the market price. So for example, in the beginning, you buy the bond, the company pay, you give $1,000 to a company. Then later on, you expect to get a $1,000 principal back. But when you sell the bond on the market may pay you $950 or $990, or the market may pay you $1,010, $1,100, depends on the market. So this is bond. And also in terms of bond, a company can issue a bond, a government, the federal government can issue a bond, state government, city government, sometimes even county government, they also issue bond. So typically bond from companies, if their business is not very stable, their bond can be risky. They can default on you. So when the bond expires, maybe the company do not have the money to pay you back. That's a risk. But good companies, so you need to evaluate. Good companies, they have a very little chance of default. Those are companies with maybe unstable, unreliable business. They may have a higher risk of paying back your principal. In terms of government has a lower risk. Why? Because the government, they typically use tax money. They tax people, they use a tax to pay the bond later on, and also pay the interest regularly. But sometimes government, they pay the bond and the interest with revenue, with money earned from a project. For example, government, they want to build a local road, or they want to build a stadium, they may issue bond because they don't have a large sum of money to build a stadium or a road, right? So they borrow money for a bond, through bond. And then in the next 10 years, 20 years, they pay you interest. At the end, they pay you the revenue back with the money from the project, from the stadium, or from the road, they collect the fees. So that's how bond works generally. The mutual fund, exchange traded fund, they are kind of related to stocks, to bond, but the difference is a mutual fund, exchange traded fund. One fund is one company, and this fund, one fund, they own many stocks. Basically, they own shares of many companies, or they own different bonds of many companies. So why do we create a mutual fund? Why do we create an exchange traded fund? When do you invest in them? So the mutual fund, one major advantage of a mutual fund or exchange traded fund is since they buy their own stocks or their own bonds of many companies, you get your risk diversified. Especially for young people when you start, or even for older people, sometimes you only have $10,000 to invest. $10,000, you cannot buy many companies, right? Even one share, some companies, even though one share is $10,000. So if you buy stocks of only one company, two companies, three companies, it's very risky. Why? Because down the road, maybe the company's business is not very good, or new competitors kind of beat them up, beat their business. Or the company had a fraud in the past, and you didn't know. They didn't disclose their fraud, and the company had financial problems. Their stock may go to 0%. Basically, their stock go to no value. They don't pay you bond back. So even you have a very good judgment, you are very professional, there is still some risk, maybe kind of beyond our expectations or beyond our control. So that's why one of the major advantages of a mutual fund, exchange traded fund is they own many companies. So if one company, two company didn't go very well, it doesn't cause you a lot of trouble. So basically, you don't. What that's said is you don't put all your eggs in one basket. So with this, a mutual fund has many baskets. An exchange traded fund has many baskets. So and some other advantages of this fund is it's easier. So instead of dealing with 20 companies, buy, sell, you only buy one fund, then you can deal with, they will buy the 20 companies, 30 companies, then you buy. And also, one of your questions maybe right now has in your mind is, does mutual fund, exchange traded fund, do they own stocks or they own bond? So some that depends on which fund you talk about. Some fund, they only own stocks. So from their kind of their description, they call it prospectus. From their description, you will be able to tell what's the scope of the investment and what's their investment style. So do they only own stocks, or they only own bonds? Do they only own government bonds? Do they only own company bonds? So you need to read the description of each bond. And some fund, they own both stock and bond. They maybe own 50% of stock, 50% bond, 60% stock, or 40% bond. So then another question you may have is, what's the difference between mutual fund and the ETF, exchange traded fund, ETF? So mutual fund has been existed for maybe at least 50 years. So it was very popular in the past. But ETFs are relatively new. ETFs started maybe in the 1990s, but they gained a lot of traction in the recent 10 years. So a lot of people, in the past, a lot of people invested their money maybe in mutual fund, but now a lot of money flow shift from mutual fund to ETFs. So then what's the difference between mutual fund and ETF? So mutual fund tend to be managed actively. So in mutual fund, you have a major manager who is a person, an investment expert. They manage the fund actively. What does it mean? So basically, in the beginning, they tell you, hey, my mutual fund tend to focus on technology stocks, technology companies, or my mutual fund tend to focus on manufacturing companies. My mutual fund tend to focus on shopping malls. So they will tell you. And then as time goes by, they will choose what they think, the manager will choose what the manager think is the best option. This company already grew too much. Price is too high. So we want to sell this company share and buy some other company to replace it. So that, in this way, their goal is to, of course, to maximize the future return for you as an investor. So in terms of, that's mutual fund. So for ETF is not actively managed. So ETFs, they own many companies, as I said. Then how do they work? So for example, if you look at the US stock market, you have one index. Every day, if you guys listen to radio or read the news, okay, the market is going down, the market is going up. So they talk about three major indexes in the US. One is the Dow Jones, one is the S&P 500, another one is the NASDAQ. So NASDAQ is more technology, biotechnology, software, computer, all those is more tend to be more those high-tech companies. Dow Jones is more traditional, old-fashioned companies. S&P 500 is they include the almost the top 500 US public companies. Not the US public companies, can be public companies traded in the US. So some companies, maybe their headquarters is in Switzerland or in United Kingdom, but they can still be in the S&P 500 if they are traded in the US. So S&P 500 tend to be the top 500 public companies. So an ETF, for example, if I start an ETF, I can start an ETF to own the shares of the top 500 companies. Then if you buy my ETF, the performance of my ETF will fluctuate with the S&P 500 index. If S&P 500 stock, the index goes up, then my ETF on the 500 companies, my ETF's price will go up. Or if it is go down, my ETF will go down, of course. And also there are many ETFs now because different investors have different needs, different interests. For example, I can start an ETF on the biotechnology of pharmaceutical companies who make medicines. Or I can even start an ETF focused on vaccines. So I think, oh, maybe vaccine is so popular, so important. Maybe I can start a fund to ETF to own the top 10 manufacturers, researcher companies of vaccines. So if vaccines go very well, my ETF will do very well in the future. So that's an example. Some ETFs, they own maybe the farming industry. Some ETFs own shopping malls. Some ETFs own certain industries. So, and recently in the last few days, somebody is developing an ETF for Bitcoin. You guys must have heard of Bitcoin, which is very hot right now. So it's keep developing. So people in the last few days, I think somebody else is developing ETF for Bitcoin. So people, when you invest Bitcoin, you say one Bitcoin is the price is about $50,000 now. If I have only $1,000, how can I invest in Bitcoin? So instead of going through some other way, you need to learn how to use a computer, how Bitcoin works. If you buy the ETF, it's more convenient. You don't learn how to keep a password, how does Bitcoin is traded, how you want to make sure you don't forget your wallet, your electronic wallet, all those technical details. You can buy the Bitcoin through ETF. So that's an example. Also, a major difference between mutual fund and ETF is when you want to sell the shares of a mutual fund, you sell your share back to the fund. Basically, you redeem your money. So you don't, if during the day, like 9 o'clock, 10 o'clock, or at lunch, you want to redeem your mutual fund share, they cannot redeem for you. They need to wait. Today, you tell them you want to redeem your shares, get your money back. You need to wait until the next trading day. Then if today market is open, at the end of the day, the mutual fund will calculate, okay, how much money the mutual fund is worth now? And then tomorrow, tonight, they calculate the shares, how much your share worth. Then tomorrow, they give you money back. That's how mutual fund works. But for ETF, it's different. ETF is like a stock. It is traded on the major stock exchanges during the business days. So you can buy ETF shares every minute if the market is open. So it's more convenient. You don't have to redeem. And then another major investment area is real estate. So when you guys think of real estate, I'm sure many of your parents, because we are Chinese people, right? We like to invest, we like to make money. So a lot of your parents, they may own one house, two houses, several houses, and then they collect money from the tenants, right? So you may think of that as a maybe typical example of real estate. But also real estate not only include residential houses, apartments, real estate also include land, include offices. For example, if you go to downtown Atlanta, you go to downtown New York, you go to major cities, you have high rise, you have large office buildings, you have smaller office buildings. Chances are many of those buildings are not owned by the tenants. Most of the tenants, they don't have so much money. Even the tenants, they have money, for example, pharmacy. If you talk about Walgreens, if you talk about CVS, or you talk about Target, right? They have a lot of money. But they also borrow money from banks to do their business. They want to leverage, they want to make more money. So they borrow money, and they don't want to spend the money on the land, on the building, on the architecture, on the architect. So that's why somebody else own the buildings, own the land, own the facilities. They rent to Target, they rent to Walgreens, they rent to or CVS or other retailers. So that's real estate. And you also have industrial manufacturing facilities. You can rent a building to manufacturers and warehouses. You can rent a warehouse to Amazon also. So that's how real estate works. And then we have others like a Bitcoin we just discussed. And you can invest in antiques, even stamps. Some people, they buy stamps, like very rare collections, and hopefully it will grow in the future. So if we look at the different categories, and I forgot to mention some more examples among the others category. You have venture capital, you have hedge fund, you have even like a gold. You can also invest in gold. So there are many other examples. So yeah, we cannot cover all of them. So, but another way to categorize all those investment options is one types of investment that generate value every month, every year. Another kind of investment that don't generate value. So the only way you make more money is you hope the price will increase. For example, if you invest in gold, a piece of gold, you put in a safe in the bank, right? Or you hide it under your mattress. You hope in the future the price of the gold will increase. Or if your grandparents, they like to collect antiques. The antiques doesn't grow money, doesn't generate value every day, every year. They just hope, they think the price of the antique will increase in the future. So you buy now at a lower price, you sell high in the future, you make your money that way. Same with the Bitcoin. You own a Bitcoin, the Bitcoin doesn't generate value. So but you hope to sell at a higher price later on. But the other kind of investment, they generate value on a daily basis. For example, a company, a restaurant, a house. If you own a house, every month, the tenant pay you rent. So every month, so you can make money from a house in two ways, right? One way is the rent from the tenants. Another way is in the future, if the housing price go up, then you can sell the house at a higher price. Same with the company stocks. When you buy a company, when you own a business, you can make money in two ways. One way is every year, the company pay you, they make a profit, right? They make a profit, part of the profit, they use to develop or maybe grow business or to fix something. But part of that profit, they pay dividend to you as a shareholder, as a part of the owner. And then in the future, you also can sell the company's shares at a higher price. So you can make money in dividend, you make money in higher price. So there are two ways. So even in real estate, if you own a piece of land, if you don't grow anything on the land, you just let the land sit there. The land doesn't generate value. But in the future, you can sell that. You may be able to sell the land at a higher price, make money in that way. But if you own a farming land, people grow potatoes, people grow fruits, then every year, the land also generates value. So, next slide, please. So I kind of touched a little bit about how to compare what's the difference between investing in stocks of a public company and shares of a private company. So one of the major difference we talked about is liquidity. So liquidity is how easy you can buy and how easy you can sell. So in public companies, you can buy, you can sell every minute, as long as on weekdays the market is open. But for private business, it's much less liquid. When you want to buy a small business, you cannot buy every minute. You need to negotiate with the owner, and maybe the owner say, hey, I'm not interested in selling shares for my company. my restaurant. And then also, if you own a 20% of a restaurant, if in the future you need your money or you change your mind, it's not very easy to sell it. That's one major difference. Another big difference is when you invest in public company stocks, they are highly regulated. The US government, they have regulations, rules. Okay, every quarter, as a public company, you need to disclose your profit, your revenue, your major change in your executives, or any major change in risks, etc., etc. But for private business, there's no such regulation. So if you decide to buy 20% of a restaurant from your friend, then you are taking a lot of risk. I mean, even you buy a public company, you still take your own risk. But a public company is regulated, is watched by many people, by the government. But private business is you need to check, make sure the paperwork they show you is accurate, or how much paperwork they want to show you. Maybe sometimes they want to hide the information from you. For public companies, it's much more difficult for them to hide the information from you. So how to invest in stocks, how to evaluate a company. So this question is a huge, big question. We're not talking about a billion-dollar question. We're talking about a trillion-dollar question. Why? Because this is the ultimate question of the financial industry. How do we make money from stocks? How do we evaluate how much a company is worth? So let me start with a simple example you guys are familiar with. Most of you maybe have gone through a garage sale, right? When you go to a garage sale at your neighborhood, and you see a very beautiful picture frame, and the owner asks for $1 or $2 for the picture frame. And if you know the value of the picture frame, then you will know how much money is a good deal, right? So for example, you guys see similar picture frame at Target for $10, or at Walmart for $10, or at Macy's. So then you know, okay, I know this picture frame, maybe $8 with $10, maybe $15. I generally know the price. So if this owner charged me only $1, $2, and I can tell the quality is good, it's well maintained, or it's brand new, it's never been used. So that's how you make your decision in a garage sale. So when you invest in stocks, you need to also know how much money you should pay. But then another way, let me give you another ideas. I think many of you maybe will think in that way. Or if you talk to your parents or talk to some adult friend, they will look at the curves. Why? One of the intriguing feature of the stock market is the curves. Most people, they are attracted to the stock market is because of the curves. So most of us, when we decide to invest in a house, we are attracted by the rent, by the potential increase in price. But many people, when they invest in stocks, they say, wow, the curves are amazing. The curves go up, go down, go up, go down. And I think I'll try to figure out when it is a bottom, when it is a peak. Then I try to buy at the bottom and sell at the peak. That's what people are trying to do. So in Wall Street, there have been two schools of thinking. One school of thinking is, okay, I don't look at the quality of the company. I don't spend time to study the business. I just look at the curve, the chart. And I can tell if it's in an upward trend channel with like a shoulder head pattern, or is kind of a reverse pattern, etc. So in the last decade, there are people trying to figure it out. They say maybe we can tell some pattern from these curves. So, and then there's the other schools of thinking. is, okay, we need to learn the business. We need to learn the quality. We need to learn how much this company is worth. So we know whether we are buying the shares at a reasonable price at a good deal, not paying too much. So personally, I believe the quality thinking, not the chart, the curves. Not only me, I think most professionals, they use the quality, the fundamental, we call it fundamental research, the research of companies. Just like when you buy a restaurant, the restaurant doesn't have a stock price. So you have to study the quality. But a lot of people, when they buy stocks of public companies, because there is this intriguing curve, they forget about the quality. When they buy a restaurant, definitely they will study the quality. They will know, hey, what's the, if the chef will leave tomorrow, will I still have a stable business? Well, if there's a new restaurant open up at the next corner, will my restaurant lose business? They will do that kind of thinking research. But when they buy public stocks, they are mostly attracted to the layman investors. They will be mostly attracted to the curves, because the curves, they think, oh, it's much easier to make money. I can buy the low and sell the peak. But actually, it's very difficult to make money in that way. And most professionals don't look at it in that way. And also my own theory, I keep telling my friends, people, if looking at the curves work, then computers will be the best investors, a human being now. Because if you look at artificial intelligence, I'm not talking about future artificial intelligence. I'm talking about the current existing technologies. They can track thousands of parameters in the curve, much better than human being. And a human being have emotion. Human being can only maybe track dozens of parameters in a curve. So if watching curves works, I think the computers already make a huge amount of money, and human being will be out totally. So that's my argument. Keep telling my friends, people, curves doesn't work. If you just look at the curve, it's very difficult. And also my own experience in the beginning when I try to invest, I also use a curve as my major reference. At the end, you lose money. Some people, they treat it as a casino. They say, hey, even I lose money, I still enjoy gambling. That's a different thing. So, and also another thing is why people like to look at the curves instead of research companies. Because if you look at the curves, it only takes you 1 week or maybe several months to learn the different patterns of the major patterns of the curves. So if you can learn something within 1 week or within several months, it's not very valuable. Just think of a barber, how much a barber make, how much a doctor make. You can learn to be a barber in a few weeks, but you need to learn a few years to be a doctor. So that's why, to me, curve is valueless. But there are still a small percentage of professionals, sometimes they use curves as reference, not totally rely on curves. Then how to evaluate a company, that's a part of the $1 trillion question. So how do we evaluate a company? There's no definite answer. Maybe it's a science, also it's partially an art. So investment is a combination of art and science. How do we evaluate a company? When we have a company here, maybe if you talk to a professional, one professional may think this company worth $10 million. Another professional may think this company worth $100 million. So they can have a different conclusion. That will make a difference for the investment results. People have a different judgment of the risk, the competition, the management, the product, and also the future technology development. So all those. So if you don't know how much a company is worth, then you buy a share, you don't know, okay, this company is $100 a share. And totally this company right now is $10 billion on the market. That company is $50 a share. Right now totally is $1 billion on the market. So how do you know you are paying high price or lower price? So the way I like is the Warren Buffett way, and also his mentor. Later on, at the end of this presentation, I will introduce you to the book by Warren Buffett's teacher or his mentor. So their way is like when you trying to figure out the value of a company, it's similar to when you try to figure out the value of a house. I mean a house for rent, not a house for like because let me give you another example first. Sorry. So in residential house, there are two kinds of houses. One house you invest because you like the rent. Another house is even the rent is only 1%, 1 per 1,000. It doesn't make sense. You invest your $1,000, you only get $1 rent. But people still invest in that kind of house. Why? Because if you go to New York, Manhattan, the house is typically the apartment very small. One small apartment can be priced at $2 million, and then a 4-bedroom apartment at Manhattan, New York, can cost $10 million. Some of them more than $10 million. So if you rent a $10 million house out, you don't get much rent. So why still people buy this house? So one house you buy for their rent, like a house maybe in Johns Creek, in maybe the suburbs. Most of the houses we buy, if we buy one, we want to get their rent. The rent need to be at least maybe 5%, 8%, or 10% for good deal. So we get a good return every month. Because you need to spend money to fix and to deal with the complaints from tenants. You have some other costs. You need to pay tax, pay insurance for the house. So for a regular house, a 6% return, 8% return, or 10% return is a very good return, acceptable. So when we evaluate a house, a company, we evaluate the similar way we evaluate as a house for rent. So we want to see that if I invest in this company, does this company make 5% profit every year, or 10%, or 20% profit every year? So we evaluate in that way. So if a company they generate, for company there's another different factor we need to consider also. So for usually house price, for most houses, most times, the house price doesn't really change tremendously. But for companies, it can be huge. If you talk about Amazon, I'm sure everybody here, you have shopped on Amazon before. So 20 years ago, Amazon only worth maybe $1 billion. But now 20 years later on, Amazon worth more than $1 trillion. So Amazon already grew by maybe 1,000 times in terms of the stock price. So if you buy a house, it's unimaginable your house can grow by 1,000 times. Because house is limited. House is only this size. You can only use a house for this amount of work. So the growth of a house is limited. But growth of a company can be huge. When you start for example, I'm talking about another local company from Atlanta called Floor and Decor. The company selling floors. So when your parents buy a house, they want to renovate the floor, either in wood floor or in carpet. Then a good shop is going to Floor and Decor. So when Floor and Decor, they started in Atlanta, they only have one shop and then into 4 shops in Atlanta. But now they grew to more than 100 shops all over America. So from 4 shops to, and also when this company went in the public market, offer their stock on the public market, they had only 25 or 30 stores. Now they have more than 100 stores. Their stores grew by 3 or 4 times already. So their stock price, you can imagine, generally should grow by 3 or 4 or even more. So that's why a company is also very different from a house. So when you buy a house, if you don't expect the house price to grow a lot, then mostly you focus on the rent. Then, as I mentioned, if the rent is about 8%, or if you can get 10%, that's very good. So for a company, if you buy a mature company, you think the company, for example, Nike or Coca-Cola, that may not grow much, right? So if you think this mature company doesn't grow very much, then you should say, hey, this company, Nike or Coca-Cola, every year they make about 8%, 10% profit. Yeah, maybe okay. But another thing, a company and a house is a risk is different. A company has a higher risk than a house. When you buy a house, your parents buy a house, you are the owner of the house. You control the house, how to manage, how much is renovation, whether the tenant should mow the lawn, do different things. You have control of the house. But when you buy a company, most of us we are small owners. We own small, tiny percentage. Even you are very large shareholder, you own 40%, you own 60%. Sometimes the CEOs you hire, they may mess up. So anyway, for most people, small shareholders, you cannot control the company. And also a house, even a house get it burned, you get an insurance company to pay you. And you can rebuild the house. The land is still there. The land is very expensive. But if a company's business going very bad, they face competition from some other country, some other companies, or the new technology totally take them out, the company's stock price can go to zero. Basically, you get nothing back. So that's why if you evaluate a house, maybe 8%, 10% is very nice. But if you evaluate a company, you ask for a higher return rate to compensate for your risk. So for a mature company, typically you want to have maybe more than 10% profit. So every year the company, when they sell $1,000 products, services, they should get a 100 or higher profit. Then they have money to pay you dividend, right? Or if they don't pay you dividend, they have money to do research, to grow, to develop new business. So that's another one way to evaluate. And also the growth factor we also mentioned. If this is not a mature company, you think this company is small, or this company is large already, but the company still have potential in some other country, the company is developing new product, then you should also take consideration that growth factor. If a company grows 10%, 20%, 30%, that's a big difference, right? If a company grows 0%, okay, I want to have at least a 12% profit rate. So the company have some percentage to pay me dividend. But if a company can grow at 10%, okay, I can lower my rate a little bit, requirement a little bit. If a company can grow 20%, then you can pay a little higher price now. If a company grows at 30%, then you can increase the price you want to pay to buy the share accordingly. So that's how the fundamental people evaluate the value of a company. All right, our next slide, please. So here, this one is specifically for young people. So why I put this picture here is this guy, he's diving into the water. So there's a little risk. So most people, maybe if you dive in such kind of open water, very deep, you may think it's risky. So one thing, when we talk about age and asset allocation, and also saving for your retirement, how to invest, is every advisor you talk to them, they will suggest you as a young people to take a risk. So what does it mean? Because I just told you stocks have much more risk than house. Stocks also have more risk than bond. I mean, depending on the situation. Some bond can be very risky, but overall, good quality bond is less risky than stocks. So for young people, that means you should buy more stocks. Don't put your money in bond. So that's a general advice. Then as time goes by, when you are in your 20s, you maybe put your 100% of your retirement savings in stocks, 0% in bond. And then as time goes by, when you go to 40 years, 50 years, 60 years, you can lower the percentage of stocks, increase the percentage of bond. So that's a general suggestion. And typically, when you guys get a job, most companies, they have what we call a 401k. So in the old days, companies, they pay you pension, government pay you pensions, but now that's gone. So pension, there's still a small number of companies that pay you pension. I didn't mention pension here, but let me discuss briefly. So pension is a company, when you work for, let's say, for at least 10 years there or 20 years there, depends on their length. The amount of money you will get from the company every year after you retire will be different. If you work there 10 years, maybe after you retire, they give you $1,000 every month. If you work there for 20 years, they give you much more money. If you work in a company for 30 years and then you retire, they give you money. And then the pension is, they always pay you until you go to heaven someday. So they keep paying you the money. So that's a good thing of pension. As long as you are alive, the company pay you money. And then if you ask me, hey, what happens if the company go to bankrupt, the company go to zero, the company is out of business anymore? That is a lot of details. You guys can Google. Today is just an appetizer for you guys. So as I said, pension is very burdensome for companies. Why? When they calculate their pension, they need to calculate how much money I need to invest to pay my retirees in the future. It's a huge burden. And as time goes by, people get to live longer. In the past, people live in their 70s. Now a lot of people live to their 90s. In the future, maybe some people will live over 100 years. So it's a lot of burden for companies. So now that's why most companies do not offer pensions anymore. They offer 401k, which is for-profit companies. And some non-profit, for example, universities or church, and church is not a typical example. Like non-profit companies, foundations, universities, research institutes, they pay you they give you 403b plans. Also, the retirement account. Basically, then you have 457, which is government. This is for government to retire employees. And then you have RRA, so individual retirement account and some other retirement, etc., some other retirement plans. So how this 401k, 403b, this 407, how they typically work? So typically, if the company is mid-size or large size, the company will every month, the company will match, why they call it match. Okay, as an employee, if you put 5% of your salary into your retirement, we will match 5%. Then most companies, they match up to 6% or 7%. So the company will tell you, okay, if you want to put 10% of your salary into retirement, that's fine, but we'll only match you up to 6%. So as an advice to young people, you should always at least put the percentage your company will match to maximize the amount of the company support, their contribution to your retirement account. And then how do you manage this 401k? In this 401k, 403bs, typically they have different options. They have the mutual fund I mentioned to you earlier. different mutual fund, focus on different industry or different style. Then you have, they also have ETF, they have even real estate, and they have a mixed mutual fund. They have what they call their targeted funds. For example, for most 401k plans, they have a fund 2050. That means this fund is for people expected to retire at 2050, which is 30 years later. So in those funds, they tend to put a lot in stocks, small percentage in bond. Then as time goes by, for example, if you have another fund in your retirement account, which is a fund 2025. So fund 2025, suppose is for people will retire at 2025 in a few years, right? So they put most of the money in bond, which is more stable, less risky. Stock is very, who knows, in the next 2 years, stock maybe go down by 30%, 40%. Then how can you get your retirement money for those people who need the money? So that's how this generally works. Then IRA. IRA is you decide to save some money in your individual retirement account, your Roth IRA, traditional IRA, and some of them they have different tax features. So the tax will affect you a lot because, as I said, young people have a lot of time, right? If you start in 25, by age of 60, 25 years old to 60 is 35 years. So in 35 years, if you can save tax every year, use that save the money to invest, that will make another difference also. So, and then I forgot to mention for 401k or all those most common retirement plans, one of the features is what they call the pre-tax money. So the money that you put it like a 10%. For example, you decide to put 10% of your salary into your retirement plan. The 10%, if you don't contribute to your retirement, if you take the 10% out as your regular salary, you spend it, then the government will tax your salary, right? If you talk to your parents, they pay typically maybe 15%, sometimes maybe more than 20% of tax to the government. But if you put 10% to work in your retirement account, the government don't tax you right now. They don't tax you. So you get more money to invest. So when do they tax you? So the earliest time you can take your retirement money out to spend is 59.5 years old. You can take your money, start to take your money little by little out to spend. At that time, the government will start to tax you. So you get your 30 or longer years to use the money you should pay the government to invest for your own benefit. So that's why you also should put a lot of money in your retirement account. But they have a cap. They have a cap to how much you can put in your retirement. It's not whatever you can do. There's a cap. And also the third point I want to highlight is, what time is it? Okay. So the third point I want to highlight is the best way to catch up with the market for dummies. So most people, you don't have the time to learn the industries, to learn business, to select individual stocks. So Warren Buffett and some other people, they suggest you should buy the S&P 500 because over the past 80 years or sometime, the S&P 500 every year they have generate about 8 to 9% return, which is very good. And if you try to guess the bottom, guess the peak, if you guys can do your own simulation in the future, you try to guess the market, chances are you will perform worse than the market. So that's why the suggestion for people is you buy S&P 500 index, which you own the top 500 companies, which is very good. Next slide, please. So common finance traps young people should avoid: delaying savings for retirement. So you guys now learn compounding effect, why you need to let your money work for you, let time work for you. So you should not delay saving. You should have a balance. How much money you want to spend now, how much money you want to spend later, you grow your money. And then also, you should have an emergency fund. Some American people, they are crazy. They have $0 for emergency fund. So once there's some problem happening, they cry, they get stressed out, they get depression. It hurts their mental health. Not only a money issue, but it becomes a health issue, family issue. So you should have an emergency fund. And also don't take a short view on investing. Avoiding the market. You should not avoid that. People are scared because in your life, you will go through different financial crises. You will go to bear market. Don't get scared by the bear market. Unless the US become a autocracy or become like a Venezuela or Soviet Union. In the future, most likely the US business, the companies will keep doing business, new companies will pop up. So even there's a bear market, don't worry, the bear market will bounce back. You will get more money back. And also don't concentrate your investment. Even you are very confident, don't bet on one or two things. I think that's the end of my presentation. By the way, if you guys want to learn more about my business, you can Google my company, Long Faith Capital. My website is longfaithcapital.com. And Marina, do you guys have any other announcement after this before we take questions? Oh, this one is a slide showing you somebody started investment as 25, somebody started at 35, the huge difference. So you should start early. Take home, okay, one more slide. So good resources. The book I mentioned is The Intelligent Investor. If you guys want to learn, you should read this book first. By Benjamin Graham. He is the teacher of Warren Buffett, and he is the kind of a godfather of the fundamental people. And also you guys can install CNBC or some other app on your phone. Sometimes you can do your chores and you can listen to some news. CNBC, they also have good tips for young people, like how to write a good resume, etc., etc. So it's very useful. All right, thank you, everyone.
So before we move on to our Q&A section, I would like to take a moment to introduce our next forum, number 10, which will be covering the United States National Chemistry Olympiad, or the USNCO, with Dr. Dong Wang. In this webinar, we'll be covering different types of chemistry. So first, we'll be covering the competitive aspect of chemistry, in which we'll be covering the journey to the USNCO, what the students can expect on the journey, the starting points, and the classes for chemistry Olympiads in general. For high school students looking into STEM fields, check out this webinar for our AP Chem preview, where we'll be covering the AP Chem curriculum, preview of the classes, and also the most important part of the AP, which is the AP exam. And then also for other students, we will be having the planning and the ideas and the process of the science fair projects, which are obviously lots of fun for the students and parents alike. And then perhaps finally, the parents, we will be giving out parenting advices. And with Dr. Dong Wang, I think we'll also be covering these parenting advices for parents with kids that are interested in the science and chemistry discipline. Okay, so now we're moving on into our Q&A section. Just a refresher, if you guys have any questions, feel free to type in the Q&A section, and I will start answering them chronologically. Okay, so the first question was, as teenagers getting into the stock market, should we invest in the SPY or get partial shares of the S&P 500?
Sorry, what's that? So if we invest in S&P 500, what's the specific question?
Yeah, so if you gave the answer, if you did ask this question, if you could elaborate a little more on your question.
Oh, okay. So basically, right. How do you buy the S&P 500 index? There are several ETFs. So basically several different companies. This company also owns 500 companies. shares. This company also owns 500 company shares. So you can buy either one of them, that's fine. So they have a little difference. Maybe one company's management fees maybe 0.5% every year. Another company maybe 0.4%. So that tiny difference you may consider. Right, whichever company has a lower, maybe a little tiny, it's a penny will count. So one symbol is VOO, another symbol is SPY. So you guys can Google ETF for S&P 500. You will be able to find those ETFs. And you can buy one share. One share sometimes is only $100 or $50. Yeah.
Okay, thank you for the response. Our next question is saying, can we go over dividend and dividend rate and also dividend per share?
Sorry, can you go over dividend?
Yes, so the question asks, can you go over dividend share, I'm sorry, dividend and dividend rate and also dividend per share?
Oh, yeah, sure. So how does the dividend work? So when you buy a public company share, you will be able to find out what's the dividend rate in the past. And some companies, their dividend rate is very stable. So you can tell their future from their past. For example, utility. If you buy a Georgia Southern Electric Company's share, if in the past they pay 4.4%, then you know in the future maybe tend to be, because the utility companies, electricity companies, they're very stable. And they are regulated, and it's not likely a competitor will drive out electricity company. So how does the 4.4% dividend rate work? So for example, if you buy $1,000 of the shares, $1,000, I don't remember how much you can buy. You can buy maybe 20 shares or 25 shares. So another thing, you guys are for amateurs, when they look at it, one company's stock price is $1,000. Another company's price is $20. They are scared by the $1,000 share price. They think the $20 share price is cheap. It's wrong. It's totally wrong. Why? Because, for example, I have two similar electricity companies. Both companies have a similar amount of business, similar profit. And both companies have a similar value, right? So by one company, they divided their shares into 1 million. Another company divided their shares into 10 million. So that will cause a difference in share price. So don't look at a single share price to see whether a company is expensive or not. You cannot, there's no clue you can tell whether a company is expensive or not by looking at one share. You need to look at the whole company's, what is called a market cap, the total value. So then, for example, if you buy $1,000 shares of Georgia Southern, they pay you 4.4. Then you multiply the $1,000 by 4.4%. That's why how much they will pay you 1 year, and they pay you 4 times. They pay you each quarter typically. Yeah.
Okay, thank you for your response and also the
You're
examples
welcome.
that you gave. Okay, so I think this is a question that a lot of parents are also wondering as well, and it is, how can parents give their stocks to their kids?
How can they do? There are different ways. One way is you can. I think that most states have a gift trust. So every year, if you give less than, I think the current total amount is $14,000. If you give less than $14,000 a gift, you don't pay tax. But if you give more than $14,000, so you can buy those stocks. If you every year you transfer less than $14,000 to our kids, it's fine. Another way is you can for young children, like people having gone to college, having are not 18 years older yet. Actually, you guys can start a Roth IRA. The parents can start a Roth IRA, not for parents, but for children. So then, but there's a detailed stipulation. So the children need to make money. So maybe children mow the lawn for the parents, do the chores for the parents, do something for the parents. Then suppose that the children earn the money from there. Then so you cannot pay too much because the mowing the lawn and doing the chores maybe doesn't worth tens of $1,000s. So that's one way you can let your children minor to set up a Roth IRA, and the parents can put the money through the chores or that way to into Roth IRA for children.
Great. Yeah, I think I might ask my mom to do that as well for me then. So I think it's a great way to start investing at a young age.
Right.
Yeah. Okay. I guess we'll go on to our next question. So our next question asks, will we cover how interest rate affects stock market and the bond market?
Oh, this is a huge question. It's complex. Generally, interest rate have a more straightforward bond. The effect of interest rate on stocks is very complex. Depends on which industry, what kind of stock. A bond is, for example, when you purchase a bond, the bond the company tell you, okay, every year I'll pay you 5% interest. Then you say, oh, this is good, 5%. And at that time, the typical interest rate is 2%. So the typical interest rate is 2%, you get 5%. That's how you decide, okay, I'll buy this bond. But later on, if the interest rate goes up to 3%, now the difference between what you earn from the bond and the 3% is not that big now. So people may shift some money from bond to some other investment. That's why when the interest rate go up, bond price will go down. So because people don't want to invest as much in bond as before. Also, they want to drive the price of the bond down. So actually the bond will earn more. Because in the past, when you purchased the bond give you 5% interest rate. But now you say, okay, since the typical interest rate goes up now, I want a higher bond rate to compensate. So that's why bond price will drop. When you purchase the bond is $1,000. Now maybe the bond price will become $950. So people, if you buy $1,000, now you buy the $950. New people buy it $950. They'll earn more interest. So that's how it is reversed. In terms of stocks, it's complex. When interest rate go up, it tends to benefit banks. Because banks, they can lend the money quickly for higher interest rate, but they don't give a rate raise to the savers as soon as they do. So that banks tend to do very well. And also some other industries, mortgage. When the interest rate goes up in the beginning, maybe it will benefit the mortgage. But when the interest rate goes up too much, then people, they don't buy house anymore, they don't do refinance. Then the mortgage companies, mortgage stocks, they're going to hurt. So yeah, it's complex. And also growth stocks. The growth stocks, when the interest rate goes too high, inflation goes high, the growth companies, they tend to get hurt a little bit. And then the stable, mature companies, they get hurt less. Yeah. And also I mentioned to you, utility companies, water companies, they get hurt because their business is very stable. They pay dividends stable, but when interest rate go up, people think they're not as good as it anymore. So yeah, depends on your industry.
Okay, great answer, Mr. Ying. So for our next question for you is, what are your suggestions for youth to develop their financial knowledge and skills?
Suggesting financial skills. I think, yeah, today is a good start. And yeah, I encourage people to maybe read the newspapers, to keep up with the development. And some other books very popular in the United States, like Rich Dad, pool that a lot of people read about it. And also, as I mentioned, you can listen to news, the CNBC, like a Bloomberg. You don't have to pay. Some part of the news is paid, but most of the free news are very good enough information for people. Yeah, you can keep doing that way to accumulate your knowledge.
And for that question as well, I think Marina will be covering also financial literacy classes that Will I Be Learning will be offering later in the slide. Okay.
Thank you,
I'm sorry.
Thank you. So is there any questions they have? Oh, that's all.
Yeah, there's still a couple left. Okay, so our next question for Mr. Ying is, should I invest in the S&P 500 as my first ever investment?
Yeah, as another thing I keep telling because I have some WeChat groups. I tell my friends in the WeChat groups. One thing is Warren Buffett, he suggested S&P 500. But a few years ago, I was mentioning to my friend. My friend said that maybe they should try NASDAQ. The NASDAQ tend to be more high-tech, like a technology, computer, software, and also biotechnology, new technologies. Those companies in the future, for example, water, you can only drink so much Coca-Cola. You can only wear so much Nike shoes. So in the future, the whole economy, society will grow in which part? In the technology part, in biotech, in healthcare, medical. So that's why in the last few years, also confirmed my suggestion. The NASDAQ had a higher return than S&P 500. By you should have both, yeah.
Okay. So our next question is about Mr. Ying's website. So I think this attendee would like to ask, what's your website? Like,
my website is
address. Yeah.
longfaithcapital.com. Long is L-O-N-G. Capital, faith is F-A-I-T-H. Capital, C-A-P-I-T-A-L.com. If you Google, you will be able to find it.
Okay, yeah, so just search up his website online at longfaithcapital.com. So our next question is for Mr. Ying, which websites do you recommend to buy and sell stocks?
Sorry, which stock?
Yeah, so this person asked, which websites do you recommend for the buying and selling of stocks?
Which broker? It doesn't matter that much. The major ones in the US is Charles Schwab, TD Ameritrade, and Fidelity, and Interactive Brokers, and yeah, those are for retailers, or individual investors, retail investors. It doesn't matter because all those are major brokers. They have access to similar stocks, and they have slightly different research tools, information. I think to me that doesn't make a difference because I don't rely on their tools. For me, I read the news, I read financial reports from companies, industry reports. So yeah, one of those brokers will work.
Yeah, and then a personal question from me. So what are your thoughts on like websites like MarketWatch or Robinhood, like that trading app?
Oh, those are good. Yeah, MarketWatch and some other Seeking Alpha. But it depends. You need to, yeah, that's why it's hard when you listen to somebody else. You need to make your own judgment because different analysts, they have different quality. Some analysts, they have a very good quality. Some analysts, that's the good thing or good and bad thing of the internet, right? On the internet, you have a lot of good stuff. You have also a lot of trash. Same for even for MarketWatch.com or Seeking Alpha. There are some trash. There are some very good reports there. Yeah, you need to use your judgment.
Okay, I'll keep that in mind. And then our next question asks about when it's a good time to start investing, and should I start with stocks or mutual funds?
In mutual fund or ETF will work best for people who don't have the time to do research, to learn also. But for individual stocks, you can learn and invest. And also another thing, if you know a company very well, either you work there, you use their service, you use their products, also that company is in your home city. You know that company very well. You think, oh, this company is very well. I think it will grow. It's very stable. You may buy it. But another thing is the bias. When people know a company, they think the company is because I know this company, so this company is good. But I also see people have a lot of trouble. For example, I used to have a friend. He worked at Walgreens, so he has a lot of his money invested in Walgreens. Then he got into trouble. So when people know a company is can be good or bad. So overall, buy individual stocks is very risky. So unless you learn enough, you do your own research. Yeah.
Great. And then I think this is a big question since we're talking about Bitcoin right now. So the question is, what do you think of the digital currency and what is your view on Bitcoin?
Oh, so overall, I think Bitcoin should be differentiated from other digital currencies. Why? Because as I said, there are two kinds of investment. One kind of investment that generates value every month, every year. Another kind of investment is like a Bitcoin. They don't generate value. So their price depends on what? Depends on the supply and the demand. The supply of Bitcoin is limited, but the demand is fluctuating. Sometimes the people want a lot of Bitcoin. A lot of people, they hate Bitcoin. They worry about the price. So Bitcoin, so it depends on how rare, how precious the asset. For example, we talk about a house in Manhattan. A house in Manhattan is very rare, very precious. So that's why a house can go to $10 million, $15 million. Same for Bitcoin. So Bitcoin, I think, is very rare, very precious, and also has some advantage than for international trade. And also in the future, technology will dominate our society. And Bitcoin has I think have a very big role in the future. But if you talk about lighter coin, even those Dogecoin, all those different coins, I think those coins they are second tier, third tier. They are not as valuable as Bitcoin. My one concern I have of Bitcoin is we need to research. Is in the future, maybe in the next 10 years or 5 years, like quantum computing. So if quantum computing can crack the encryption of Bitcoin, then the safety of Bitcoin is a big issue that may hurt Bitcoin. So I'm not saying that will end Bitcoin. We need to research. If Bitcoin has a strategy to adopt to the quantum computing. So if I use quantum computing to encrypt. If there's a new way, then I think Bitcoin is not a problem. So yeah, we need to do. I haven't done enough research in Bitcoin yet.
Okay, and then before I get to the last question, the Q&A, I think there was a couple of questions that was mentioned in the chat. So let me read those real quick, and then I'll finish us off with the last Q&A question. So in the chat, this was probably in your slides before, but Michael Chin asked, does this mean that investing in companies mean more opportunities for growth, but also greater risk, but houses are also more controllable?
Right. So risk is a relative term, right? So that's why when people in my WeChat groups, people tend to ask me, hey, why about this company? Why about that company? Most times I don't know. Even I know that company, I know the business, but I don't know yes or no, should you invest in that company or not. Why? Because one typical example is there's a pure technology companies. I'm not talking about internet companies. Internet companies, they are not pure technology companies. They rely on business model, and it's unlikely next month a new technology will disrupt existing internet company. When I'm talking about, for example, a pharmaceutical company, a biotechnology company, or a semiconductor company, those are companies very risky. Why? Even you have a perfect drug medicine today as a pharmaceutical company, by next year, maybe there's a new drug. They are more effective than your drug, or they have better safety than your drug. Then people don't want your drug anymore. So that's a risk of pure technology drug companies. That's one kind of company. When people ask me, I say I don't know, because I don't know whether next year the company will be disrupted or not. Even they have a patent. The patent only protects them for certain years, and if there's a new technology, their patent is worthless. So that's why that's kind of company. Then there's other company, either the industry. The industry is not my expertise, or the industry is not very stable. So then from the other angle, I can tell you what kind of company I like to reduce the risk. So I can think of two types of companies I like. One is the company has a network effect and a winner take all. So in some kind of industry, you have a winner take all. The winner take everything. There's no chance, very little chance the losers can beat. That kind of business is very good. Like Amazon is in a winner take all business. Why? Because same to Walmart. So Walmart has been doing very well in the last 30, 40 years. Because Walmart is a winner take all. Why? Once you have a winner, the winner have scale. They can purchase supplies at lower price than their competitors. Then they can manage the cost lower. They can sell the price cheaper to their customers. So that's very difficult for competitors to sell it lower to attract the customers. Same for Amazon. Amazon not only has some other business, but Amazon's model is once they has a scale, it's very difficult for a new competitor to have a lower price than Amazon, have a better service. So that's why this kind of company I like. Then you have a network. So another company I like is by the price is not cheap. Is like a PayPal. PayPal has a network effect. So many of you maybe have used the PayPal before. You have a PayPal, you can pay money to each other. And another example is Facebook or WeChat. So once you start with, people get used to Facebook, WeChat, then it's very difficult for a competitor because your friend is on WeChat or your friend is on Facebook or Instagram is the same thing. If your friend is on Instagram, it's very difficult. There's a new app, say, hey, come to my app. You say, oh, my friend is on Instagram. Why should I go to your app? So there's a network effect. There's a kind of companies that they have a more kind of less risky, even they grow very fast. So yeah, sometimes in high kind of new technology, new internet companies, if you find that this kind of companies get it buy at a very good price, then it's a very good opportunity to invest.
Yeah, Mr. Ying, and also I think you're kind of touching on our next question, which is personally, what is your return? What are your investments, your individual stocks, and your options?
Return in the last 10 years, my return is about 18% every year. I think it's better than 90% of the Wall Street managers. And Warren Buffett in the last his career, of course he's better than me. Warren Buffett's performance is more than 20% per year in his career. But in the last 1 year, he's worse than me. For last two years, he was worse than me. So, but I like Warren Buffett. I think he sometimes when I read his words, it makes me comfortable. So, in terms of stocks, yeah, right now my stock is I have one stock is a pure technology, but I think that technology has some advantage. So it's Intuitive Surgical, which is the owner of Da Vinci surgical robots. And then I have some other ones. I have a Microsoft. And most of my other stocks right now, I have a lot of cash also right now because I think a lot of the companies are very expensive now. So I want to increase the percentage of my cash. But I have more money in some other stocks, mostly in the pandemic recovery stocks, like some oil companies, oil pipeline companies, and American Express, which is a credit card company, some traveling like Expedia, that kind of companies. Thank you.
Yeah, well, I think it's very impressive, your return rates, Mr. Ying. You're reading a lot of Wall Street people. Impressive. Okay, also, I think we're gonna close this Q&A section with the last question, which is asking about joining your WeChat group.
Oh, yeah, I can type my WeChat ID here, or I also have a WeChat ID on my website.
Whichever one's more convenient for you, Mr. Ying.
Yeah, I just type it here either way. All right, thank you everyone. Thank you for the audience.
Okay, if you found any of that interesting, Blue Ivy Learning is providing a youth financial education summer camp. The first class is the Wharton Global High School Investment Competition Boot Camp for grades 9 and above. It covers investment strategy, risk management, stock valuation, portfolio diversification, and industry analysis. We also have financial literacy level 1 for grades 4 through 6 and financial literacy level 2 for grades 6 and above. If you are interested in any of those classes, screenshot this QR code and scan it to join the WeChat group. Okay. If you have any questions about any part of Blue Ivy Learning, here are our contact information on various platforms. Thank you for making us part of your day, and I hope you enjoyed this presentation.
Thank you guys. I had a great time working with Mr. Ying and Marina. I hope I will see you guys at our next seminar. Thank you guys.
All right, have a good evening, everyone.